This video provides an analysis of Amazon's Q3 fiscal year 2025 performance, focusing on AWS reacceleration, AI infrastructure, and operational efficiency. The quarter was defined by aggressive capital investment alongside robust high-margin service growth. Net sales reached $180.2 billion, a 13.4% increase. AWS year-over-year growth was 20%, and the adjusted operating margin reached 12.1%. Core services continue to drive structural margin expansion. Service sales grew 16.3% year-over-year to $106.1 billion, confirming that higher-margin services remain the primary engine of total enterprise value. Operational efficiencies in logistics helped expand gross margins to 50.8%. International scaling also saw strong revenue growth of 14% year-over-year, benefiting from favorable FX tailwinds. AWS secured a strong position with a $200 billion backlog, providing high visibility. Growth is usage-driven, and depreciation expense rose to $5.6 billion due to AI and cloud capacity expansion. One-time charges of $4.3 billion, including a $2.5 billion FTC settlement and $1.8 billion in severance costs, obscured operational improvements. Excluding these, operating margins expanded to 12.1%. Amazon is actively pursuing the AI investment cycle. This includes a $9.5 billion non-cash gain from the Anthropic strategic bet and increased capital expenditure to support generative AI workloads through 2026. Operating cash flow increased to $130.7 billion trailing 12-month, but free cash flow compressed to $14.8 billion as the company invests heavily in future capacity. Total liquidity stands at $94.2 billion. Critical risks include ongoing antitrust proceedings with potential for billions in damages. Macroeconomic factors, equity volatility related to investments, and regulatory tax disputes are also being monitored. Amazon delivered a quarter of strong underlying momentum. Revenue accelerated, led by AWS growing 20%, signaling improving cloud demand. But reported operating income was flat, weighed down by $4.3 billion in one-time legal and severance charges. Net income was also distorted by a $9.5 billion non-cash gain from its Anthropic investment, making headline EPS misleading. The real story is classic Amazon. Core operating margins are improving, but those gains are being aggressively reinvested into a massive AI and cloud Capex cycle. Earnings quality is mixed, and free cash flow has fallen sharply, but competitively, Amazon is strengthening its position in AI and cloud, even as regulatory risk remains a growing overhang. Thank you for watching this video. Please leave us a comment with any questions or discussion points.